Hey, everybody, welcome. Today, I want to take this opportunity to discuss with you a little bit of a different topic or a different analysis that we're taking into consideration with what's going on with the market with such banks as the Silicon Valley Bank as well as Signature declaring bankruptcy and foreclosure based on what's been going on and the disruption that it's causing in our market. There's some things that I want to show to you and keep you a little bit abreast of the decision that could come. And we really have a 50-50 outlook to what the Fed might be doing next week when they make a decision to whether or not they're going to increase our basis points for mortgage interest rates again and what that is going to look like. So let's take an opportunity to look at what we've got on screen. If you're not familiar with the fear and greed index, it's a great way to kind of anticipate what's going on in the market. It really does 7 different fear and greed indicators, and they come in several different forms. So you can see down here, if you just literally type in fear and greed index, you'll find the CNN fear and greed index, and you can kind of dive a little bit deeper into the 7 different categories. But as you can see, last week we weren't in extreme fear mode. Some of that has to do with what just happened with the banks, with Silicon Valley Bank and Signature Bank in New York. Now, a month ago, we were in greed mode. We were in a positive outlook of what the market was looking like. Now, a lot of us were a little bit in the mortgage industry. It was a tough month for mortgage interest rates, but the overall market was pretty good. So this new change with Silicon Valley and Signature obviously has us on pause. Additionally, something that we were hoping for was that the Fed doing their interest rate hikes would obviously curb inflation because that's their job. We didn't see it perform where we really wanted to. Only a slight difference from the 6.4% last month, or February, now we're sitting at 6%. These interest rate hikes have been going on every single time the Fed has met since March 17th of last year. So we're coming up to a year. So going from close to 9% to 6%, the hope was that the Fed would be doing what they need to curb inflation, and then the inflation number would come down even more than where it's sitting right now. So it's a little bit of disappointment, especially with some of the information we're getting from the CPI index, the jobs report. A lot of the jobs that are out there right now that are high peak are from the tourism and hospitality. So people that are entering in the market that lost their jobs during COVID and now are regrowing the tourism and hospitality sector of things. So it's not a key indicator. So there's some kind of mix up with some of the information that's going on where people are seeing a little bit of a positive, but it's not exactly positive if you're really getting into the weeds of it. Additionally, I'm using MBS Highway just to kind of show you where mortgage interest rates and how we kind of look into lock opportunities. But you can see when Silicon Valley announced late last week on, I think it was on Friday specifically that it hit the news, we were starting to kind of go, we had a little bit of a tough week last week, but then it bounced right back in the last few days. And obviously we're going to see a slight change because what happens on the market itself with Dow and S&P doesn't directly impact us. Remember, there's a lagging indicator for mortgages. So with this new outcome with the CPI and the inflation rate lagging indicator, we might see an impact in mortgage interest rates coming up soon, which is why we're seeing red is bad, green is good. And the thicker the candlestick, the more indicative where the interest rates are going to go, and the next day is going to show us where they're going to go. So we could very well see a mix of the market the next few days. So what does this mean? Well, the Fed is meeting next week. They will make a determination of whether to increase mortgage interest rates again and increase their basis points. Some experts are saying if there is another bank that, like Silicon Valley and Signature Bank, go into foreclosure, they will halt doing those increases for next week if that comes to fruition. A lot of other experts are saying they still need to increase interest rates to curb inflation because we still didn't see a significant decrease in the inflation rate where we were hoping it was going to go. A slight change. Again, we were at close to 9% this time last year, and a 3% difference slightly is not exactly what we were hoping for with the continual increases by 50 or 75 basis points every single time the Fed was meeting. So what you should know is next week is going to be a critical time, especially if they decide not to increase mortgage interest rates. I don't think they will. We will have to see where that comes. If they decide not to, it could be a really good rally for the mortgage interest rate market because they're not going to make that increase, which could level out or decrease mortgage interest rates, which give you, the borrower, the advantage if you are looking to purchase in the next month and lock into a rate in the next month. So stay tuned for more information. Of course, we'll keep you updated with what the decision comes out from the Fed next week. And if you do have any questions, of course, reach out to the Kearney team and we're more than happy to help. Have a great day.